Beating the market is one of the most sought after accomplishments ever, and for good reason. If you could consistently beat the market, you could supercharge your personal finances and reach financial freedom so much faster. Of course, if you really could beat the market, there would be millions of other people paying you to invest their money for them. You could be a billionaire. So, can you beat the market? The short answer is no, and I'm going to give you 4 reasons why. For anyone that's new, I'm the fireman, and I'm trying to reach financial independence before I turn 30 years old. And investing is an absolutely critical component of achieving that milestone. So before I get into why beating the market is so difficult, let's talk about why it's so important. Not only am I investing to speed up how quickly I'll reach financial freedom, I'm also counting on those investment returns to enable a retirement that lasts forever. Of the 3 steps that you have to do to reach financial independence, which are making money, saving money, and investing, I think investing is probably the most popular. The premise is just so good. It's basically free money. And historically, the stock market, or at least the S&P 500, has returned, even adjusted for inflation, around 7% per year. That's not bad. But what if you could beat the market? With a 3% withdrawal rate, you'd need 33 times your annual expenses to consider yourself financially independent. And that's doable, but what if you could consistently beat the market by a few percentage points? If a 5% withdrawal rate was safe, you would just need 20 times your annual expenses to reach financial freedom. So if you spent $40,000 a year, that would bring down your required nest egg from $1.3 million to just $800,000. I don't know how long it would take you to save 500,000 extra dollars, but for most people, that's measured in decades. So beating the stock market could have insane financial benefits, and there are obviously a lot of really smart people that have tried to do just that. So why have 90% of the professional money managers failed to beat the market? First up, let's address a common misconception. See, a lot of people assume that the market return is the same thing as an average return. The market return is an average in that it averages the gains and losses of all of the companies traded on that stock market. But it's not the average return that investors actually get. If the market return was the average, then you would expect in any given year, 50% of investors would beat the market and 50% would underperform. And of course, everybody thinks they're better than everybody else, so a lot of people assume it shouldn't be that difficult to be in that top 50%. Unfortunately, it doesn't work that way. When most people pick stocks, they often don't pick a random sample of stocks to invest in. What happens is popular stocks are inflated, and unpopular stocks are often oversold. Plus, many people fail to build a properly diversified portfolio, or they buy and sell off of emotion. All of that, and a number of other small issues, has meant that the average return of the stock market has actually been historically much higher than the average return seen by individual investors. Low-cost index funds or exchange-traded funds have outperformed the vast majority of investors, even the professional money managers. Second, the only way to beat the market is to invest in a subset of the market. And there are ways to build diversified portfolios that aren't the entire stock market index, but it is more challenging. For most investors, beating the market requires taking on more risk. And it doesn't take too many bad bets or big hedges on just one investment to seriously erode your investment performance. I personally never leverage my investments because that just adds even more risk. To offset these losses on bad gambles, you would need incredibly high returns, which is really unlikely. In other words, the big setbacks that come with taking these big risks means beating the market over a long period of time is close to impossible. But honestly, one of the biggest reasons it's so difficult to beat the market is because it's not enough to know which companies will grow and which will shrink. That's because competition is in the game. See, anybody could have told you that over the last 2 decades, online shopping would increase and that would hurt at least a few retail stores. But since everybody already knows that, that information should already be factored into the price. To actually consistently beat the market, you need to know which companies will grow or shrink even more than they're already expected to grow or shrink. People miss this a lot. See, a company's shares could decrease in price even after posting great news. And a company that shares terrible news might still see an increase in valuation. What influences these changes in valuation for a company isn't actually how a company performed. It's how that company performed compared to what the market already expected. If it's better news than the market already planned for, then the value will increase. But if it's worse news than the market expected, the value will shrink, even if that worse news was good news. Of course, you can try to be one of the first responders to profit off of this new surprise information. But unless you can trade faster than the massive New York Wall Street firms, then this will be a pretty challenging strategy too. The last reason you can't beat the market is because beating the market isn't actually enough to beat the market. That's because if you invest with a financial manager, they're on average taking a 1% cut. That might not sound like a lot, but 1% is a really big deal. On average, the stock market only goes up a few percentage points per year. Beating the market after already losing 1% is super challenging. Compare that to Vanguard's total stock market ETF. It has an expense fee of just 0.03%, and it's tracking market returns. That's a huge advantage over financial managers who, even after charging more, are usually losing to the market. Of course, you can try to beat the market yourself without the help of a financial manager, but just make sure that you're keeping in mind taxes. Since investments are usually made with after tax money, the returns on these investments are usually treated more favorably. In other words, they're taxed less. But that's only if those investment returns have come from a long term investment, one that you've held for over more than a year. Otherwise, those investment returns are treated just like personal income. So even if you could beat the market, it might cost you a lot to do it, which would still mean less money at the end of the day. So look, I'm not a financial advisor, and I'm definitely not your financial advisor. Maybe you can beat the market, and I really hope you can. For me personally, the four reasons I just talked about are why I keep my personal investments super simple, and I don't even try to beat the market. By the way, this video is the third in its series, and I'll link the other videos in the description. You can also find them right here. In the first video, I explained the efficient market hypothesis, which underpins why it's so challenging to beat the market. So check it out, and if you like this video, hit the like button. Otherwise, I'll see you next time.